And away from all the markets, volatile global financial conditions and commodity prices, as well as rising debt levels due to addressing infrastructure needs, continue to pose a challenge for Sub-Saharan Africa growth in 2019. The director of the African Department of the International Monetary Fund, Abebe Selassie, talks about effective policies for economic diversification and growth in the region.
Sub-Saharan Africa's economy continues to recover in terms of economic growth. This year, we're expecting growth to accelerate to 3.5% from 3% last year. But these regional average numbers mask quite a lot of difference in terms of outcomes across the region. Specifically, some 21 countries are expected to grow at 5% or more this year. And so, per capita income increases that are markedly larger than many countries in the rest of the world. These economies that are growing fast tend to be the more diversified economies. Still, there are another set of countries, around 24, mainly resource-dependent economies that are facing sluggish growth in the near term and are seeing slower improvements in standards of living. This group includes some of the larger economies in the region, the likes of Angola, Nigeria, and South Africa, which account for more than 50% of the region's output. External and domestic developments are having a bearing on the economic outlook. On the external front, perhaps the most important factors have been the volatility in global financial conditions, as well as volatility in commodity prices, which are posing a challenge for policymakers. Domestically, one pressure point remains rising public debt vulnerabilities. These are elevated in some countries and posing a challenge. The reason for the increase in debt levels tends to be very country-specific. For some, it is due to addressing their large infrastructure needs. In others, it's been the effect of the commodity price shock that hit countries between 2014 and 2016. And yet in others, it's been pro-cyclical policies which have led to the marked increase in debt levels. Looking ahead, we see basically two broad implications for policies. First, in the fast-growing economies, the likes of Benin, Ethiopia, Ghana, Senegal, there is a need to hand over the growth, the reins of growth from the public to the private sector. In many of these countries, public investment has helped spur higher growth, while also, of course, translating into an increase in public debt levels. So there's a need to strike a better balance between public debt increase on the one hand and the continued investments that are needed in public investment. In the slower growing economies, the likes of, as I just mentioned, Angola, Nigeria, South Africa, there is a need to pursue reforms to facilitate economic diversification and address remaining economic imbalances. In many of these cases, private investment remains weak, and a strong focus is needed to address the constraints that are holding such investment back. One development that we are very hopeful will facilitate growth is increased trade integration in the region. We're very encouraged by the progress that's been made towards the African Continental Free Trade Area. Once completed, the trade agreement will establish a market of 1.2 billion people with a combined GDP of $2.5 trillion. The benefits could be substantial, particularly if countries tackle non-tariff bottlenecks to trade, including by investing in infrastructure, lowering logistical costs, and improving trade facilitation. What is interesting, we think, is that intra-regional exports in Africa are more diversified and have a higher technology content than Africa's exports to much the rest of the world. Just to give you a couple of numbers on this, 40% of intra-regional trade is accounted for by manufactured goods, whereas when the region exports to the rest of the world, 75% of such exports tend to be minerals, the likes of crude oil and other commodities. Still, one thing to note, of course, is that to ensure the benefits of intra-regional integration are shared by all, policymakers should be mindful of the adjustment costs that integration could entail and move swiftly to address those. In addition to these more medium-term challenges that I've been noting, we see, countries, of course, have been hit by significant shocks. Two such examples I want to highlight. I think the first is a security challenge. Overall, the conflict levels in the region tend to be much lower than in the 90s and even early 2000s. But countries in the Sahel and the Lake Chad Basin are facing considerable security threats. In this regional economic outlook, we have done some work looking at the recent trends and the economic impact that conflicts are having. This is an issue of great concern, and we're discussing with country authorities how best we can minimize the diversion of resources away from much-needed development spending. Another example of the kind of shocks that policymakers have to contend with, of course, are weather-related shocks. As you know, Cyclone Idai has had a devastating impact in Southeast Africa, leading to the significant loss of life and damage. We're doing everything we can to support the countries that have been affected. Just to give an example, we have moved very rapidly to support Mozambique through a rapid credit facility. We expect the executive board to consider this request as soon as next week, within a month of the hurricane hitting, the cyclone hitting Mozambique. In Zimbabwe, yesterday we announced a staff monitored program which will support the government's economic policies. We're having extensive dialogue with authorities. And in Malawi, we are in discussions with authorities to provide additional support through the existing ECF arrangement we have with them. Before I end, I would like to stress that Sub-Saharan Africa remains a region of tremendous economic potential. And while the global environment is increasingly uncertain, there is much that the countries are doing and can do to sustain very high rates of growth, which we are certain will translate into continued improvements in development outcomes.
Abebe Selesi, Director, African Department of the IMF. When we come back after the break, IMF approves funds for Zimbabwe's reconstruction after Cyclone Idai. Just stay with us.